Hey, and welcome to another episode. So, today we're going to have a conversation about the potential future of property prices. Now, the current property market, obviously, it's in a situation where people are definitely worried, skeptical, keeping a close eye. Prices aren't as straightforward as they were a year or so ago. And we're definitely seeing a transition period in the market, but we're always looking to look at data or look at trends to see where can we place the market going forward. Now, something that I highlighted recently, and hence why I want to talk about on this episode, is I've highlighted that there may be a potential another property price boom. And why do I say that? I say that because looking at the 18-year property cycle. Now, if people don't know what the 18-year property cycle is, we've mentioned it on previous episodes, but I suggest you look it up and do your research on it. But in short, it's collective data across many, many years that have basically mapped out a rough 18-year property cycle that the UK goes through. And the cycle has 4 phases. So you have the recovery phase. So this would be after a downfall in the market. So most recent example with the financial crash, 2008. So we had the crash, prices dipped, went down, and then the start of the cycle takes place. So that's the first phase, recovery phase. You then have what's called a mid-cycle dip, which is where the market dips slightly. Then you go into the explosive phase, which is where it really takes off, hence the name explosive.
Yeah.
And then the final phase 4, is the recession phase. So that's when the prices come down again. So they're the 4 phases. Now, people must be sitting there going, well, you've had the boom phase. Like, we just seen the boom phase during COVID. Like, prices have jumped up. So where do you think this next boom phase is? So my thinking behind this, and I'll get your take on it as well, Matt, is looking at the data. Since prices have been rising, okay, we haven't had the mid-cycle dip. Now, without the mid-cycle dip, you would also be thinking, well, where is the boom phase then? So have we just had a very long period of property growth? And yes, the last part of it was quite aggressive.
Yep.
Again, this 18-year property cycle, when you look at it, it's just an average. It doesn't follow suit exactly to the T. It can be slightly different for each cycle. So have we had the initial recovery phase? And are we now in the mid-cycle dip? Because remember, it's just a dip. It's not a crash. And when we had the Bank of England putting the rates up, the mortgage market go crazy, we had the mini budget, which Kwarteng gave us and put shock around the whole economy and, again, really affected the property market. So when you look at those facts and you look at the property prices at the moment, like some stagnant, some only incrementally increasing in the south more so, there has been slight decreases. But this is where I come on to, everybody's forecasting a crash, were they not? I mean, you probably heard it from a lot of people.
All the time. Honestly.
Price is going to crash.
Honestly, all the time.
I've heard 35% from one guy, which is just crazy. And he's still to this day, on social media, won't stop banging on about 35%. Now, I won't come onto that because all those sort of people that haven't seen it, they're still adamant there's going to be a crash. But they're starting to change their predictions a bit. And look, a broken clock is wrong 2 times a day. So yeah, that's another conversation. But yeah, so you've heard it. Everyone's going to crash, and rightly so. People could have sort of thought that. But when we look now and we look at the market, it hasn't crashed. And when we look at the fundamentals in place in the market, it doesn't look likely to crash. It looks like this is it. It's had a bit of a dip in some places. Like I said, there's still positivity in other areas, mainly north of the London area. but other areas are still okay. Not growing as aggressively, but they're steady. So then that's why I think, well, maybe this is the mid-cycle dip. And what comes after the mid-cycle dip? We see the boom phase. And then I got thinking, well, okay, look, we've got the dip here. So there's been I think the latest home track report was like 1.1% house price decrease is the latest figure for year on year. So again, that's not that bad. And that drag down is brought by the south of England, because you've seen the data, haven't you?
Yeah, as you said. So I think, as you said, after COVID and what's all happened, we have been on such a high, and eventually it had to stop. It wasn't going to continue or be able to continue to do so. So there was going to be a time where there either had to be a dip or some stability had to come back into the market.
Exactly. And I mean, I'm just looking at some of the data here. So the latest home track report, you've still got the likes of in the green, which is positive. You've got Manchester, okay, albeit not massive, 0.1%. Liverpool, 0.1%. Same with Birmingham and Leeds. I remember I actually saw the data for this one, Halifax, funnily enough. I think it was over 3% growth at the moment. So there are still always some areas, but then we look at Bournemouth, minus 2.6%, Cambridge, minus 2.3%. So okay, but not the end of the world. It's still a dip, but it's not massive. So that's when I'm thinking, well, maybe this is the dip. And then when we look at what's going to cause the next explosive phase, which some people may be asking, like, how's it going to explode? Well, look at the market at the moment. There's a lot of people sitting out of the market, sitting on the fence because it's affordability. So the reason the market hasn't crashed at this moment, if anybody isn't aware, it's because the main catalyst that's caused this stagnation and issue in the market is around the mortgage market because of rates, cost of living, and affordability. So you'll hear us constantly at Track Capital talking about affordability, and that's where we're focusing areas where we're still investing where affordability levels are good. But that said, so people are stretched, but when the rates jumped up, what people don't realise is after the 2008 crash, when lenders were coming back into the market, and shortly after that, they started putting in higher stress tests to basically combat the occurrence of that happening again, like really reducing the risk of it.
Which before nearly anyone could get a mortgage, right?
They didn't even look at your income. You could get 100%
walk through the front door.
It was
get a mortgage and get out.
So they put in stricter criteria, stricter stress tests for getting a property loan to values as well. They were more careful on, and because of that, and when rates have gone up, people that had the rates at the more favourable, to say 2%, they were stress tested at like 7%. So although it's not ideal for them, and yes, they will feel the pinch when remortgaging at the moment, hasn't stopped them completely. Yeah, and that's enabled the market to sort of steady and still hold firm.
Which beforehand it would have affected.
Exactly. And like lenders now are being higher and more stricter with their stress tests. So again, covering themselves for that. So there you go. So the mortgage market and the property market, we've seen are fine. So the mortgage market's caused issues, but the property market has stayed firm. So that's where I'm like, okay, so what's going to happen next? Well, look, the mortgage market is technically settling. We're seeing interest rates come down. Predictions for next year and forecasts is that mortgage rates will start to get better, just where more products come out and lenders start competing a lot more. Because remember, they're still building their margins. And also, you then got next year where potentially it's the latter part of next year, earlier, who knows, but there is the potential that the Bank of England could reduce the base rate. So if that happens, then you've got a catalyst of, okay, it becomes a bit cheaper. It's not going to go back down, but we see the margin of 4 to 4.5% mortgage or base rate. And mortgage rate, 4 to 4.5% mortgage rates, we see as a good level. The market's good, healthy demand, and that's a nice stable property market. Anything above, it starts to get anything towards 5% starts to go a little bit sort of harder and stagnate a bit. And anything above 5%, we've seen the repercussions of that. It definitely slows it down. And anything below 4%, then it's flying. So you've got that. So once the market does settle, if rates come down and the Bank of England cuts interest rates as well, we are potentially going to see a lot more people enter the market.
All the people currently on the fence.
But not only that, what a lot of developers are doing at the moment they're putting on hold and canning some of their developments. They're not building as much. They're restricting what they're building. So our flow of supply is being restricted still. Okay? So again, when more people come to the market, there's not going to be the stock needed. Supply and demand imbalance could easily cause an explosive phase. So it's going to be more affordable, more people come to the market, and there'll be a restriction in supply. So you've got these factors, which are main fundamental driving factors for property prices, which I believe could then be the catalyst for the explosive phase that we see, especially because if prices do stagnate in some places, then if wage growth carries on as well, again, affordability comes to a level. So that's what I see as really being a catalyst for why I think the explosive phase could be next. So why am I saying that? Well, look, in a mid-cycle dip, you don't wait for the end of the dip, because by the time you know it's the end of the dip, it's too late. Everybody's re-entered the market. So now is a good time to be like, oh, cool, I'll hold. Even if I buy in a location in the south and it drops 2%, doesn't matter, because what I'm banking on is maybe 2025 onwards, or maybe even earlier, late 2024, I'm going to see explosive phase where the price is going to grow up. And what always happens, even in the recession phase, at the end of it, once a recession phase stops, it's always higher than where you would, if you bought at the bottom of the mid-cycle dip, it's always going to be higher than that level anyway. So if you buy now, even if it drops slightly a bit more in the mid-cycle dip, you're still going to be better off in the outcome.
Absolutely. And I think as well, as we always mention, you're not factoring in that the rents are
rental
at an all-time high, and they're going up around 10% a year across the UK as an average. So, as you said, if you're looking to hold, then there's no reason. I mean, of course, people want to buy in at a good time, they call it.
Yeah.
But as you said, if your main goal is to sit and hold it for a number of years, then realistically, it's still a good time to buy for sure. And there's, as we've seen more so nowadays, is there's generally some really good opportunities out there at the moment, because the market's not being flooded. A lot of people are on the fence, so some people as well are much more likely, with developers, for example, likely to do more deals and offerings as such. And as you said, Toby, like when potentially this influx does come all back in, what do you think is going to happen to the prices? Everyone's going to be
adding
them higher and higher, which of course then you could say you've got in either too late or in the midst of the boom.
And there's one more thing I haven't mentioned yet, because this is a far out prediction, but it wouldn't surprise me if, remember, we've got a general election coming up, okay? So another catalyst to cause this could be, even if it's Conservative or Labour, okay? One thing they always try and pride themselves on as a political party is the housing issue, and solving the housing issue and the property market. When the new political party, if there's a new political party, if it's Labour or if Conservatives stay, what might also happen is when they get in, they may be like, right, we really need to drive the property market to make us, well, obviously to help make us look better, make a statement.
Yeah.
You never know, they might bring in another incentive, a government scheme, like the Help to Buy or something like that. So there might be an introduction, and it wouldn't surprise me if they did, or even the Conservatives brought one in before the general election as well, which could then be something would then boost the property market. So once you've got something like that in the mix of an incentive, a scheme,
these are all factors that benefit, don't they?
Exactly. So if that was thrown in the mix, plus you've got a stable economy, plus you've got more affordability from people once it stabilises and rates stabilise and mortgage rates come down, you have got a real catalyst and a fuse which could light the property boom price phase. So that's why I think, now look, this is just my opinion when looking at data and looking at what's happened over the past few years, interpreting, because again, I'm just interpreting how I'm seeing the property cycle potentially. That's just what I'm thinking. And when you do stack the data up and you do that, it doesn't look like it's far off. But look, who knows? That's just my opinion. If we had a crystal ball, then we'd be very, very rich. The same as if you hear people telling you that the market's going to crash 25 to 35%, like we just spoke about at the beginning. Don't believe them, because they don't know. Yeah. They might be saying that, but they don't know that.
It's all opinionated, isn't it? As with most things within most markets, to be fair, and most industries. So I think that's one thing to take with a pinch of salt in a way, right? When you're hearing these things, it's the same thing as you said there, Toby, with someone mentioning that. I get investors now and again, and they're thinking that property prices are, I'm just going to wait until the crash happens and then I'll invest.
Yeah.
It's like, okay, that's fine. And then you speak to them in 6 months later and they're still waiting. And these are people, unfortunately, that do generally end up never buying in the end, because either something comes up, they spend their money elsewhere, and then they're regretting the decision to have entered the market when they possibly could have.
Yeah, exactly. The opportunity cost of not acting is a lot higher. And yeah, like you said, we've seen that over the years. I've seen it multiple times.
It depends, obviously, what strategy you're doing, isn't it? If you're in property for a quick flip or the short term, then yes, maybe this market right now might not be the best option to do something like that. But with lots of people within the market, I find a lot of people always look to hold in the long term. Then absolutely, there's right now is a good time to still buy for sure.
Well, exactly. I think exactly why that's never stops me buying, because even if my forecast is wrong, and again, I'm going to be purchasing and having this forecast that I've presented in mind. Let's say I was completely wrong. I bought today and the market crashed more than 10%. To me, I'm not going to be obviously over the moon, but I'm not that fussed, because the rental income still comes in and I'm still making money off that.
Yep.
So I'm doing well because I've locked in my mortgage rate. I'm solid. Maybe I fix in a 5-year rate. I know what I've got for the next 5 years. I'll be making money off the rental income. Yeah, the price has dipped. But look, worst case scenario, it dips 10%. Well, I put 25% down on a buy-to-let mortgage. I'm not in negative equity. So, hey, that's fine. And then in 10 years' time, I've had the rental income in and the price could have potentially doubled, depending where I've bought. And I'll be sitting there going, yeah, I'm so glad I bought. Although it was a tough time for the first 2-3 years. Then after that, I've done very, very well. And that's what we've seen in the past. And that's why I think a lot of people forget these cycles.
Yeah.
And I always say, if you speak to someone like a grandparent or something and you ask them what they bought their house for, or if they know someone what they bought their house for, and then you hear some of the figures like £10,000, £20,000, and they would have told you at that point, there's no way you'd be getting to the price you are today.
Exactly.
But they did.
And if we look at it now, you'd be like, what an investment that was.
Exactly.
Whereas at the time, some people would be like, that's mad buying it at that price.
I remember when I worked in Surrey as an estate agent, many years ago now, and I remember the prices going up there.
Was that 19... I'm joking.
How old do you think I am, right?
Yeah, carry on.
I'm still 21 if anyone asks. No. So yeah, and I remember prices going up, and I remember speaking to somebody who was looking to buy, and prices were really jumping up, and they were getting priced out because it was moving quite quickly. And I remember them saying, "There's no way it can go any higher." And I was looking at these prices, and at the time, in my naivety, I kind of went, "Yeah, no, do you know what? I don't think they're going to go much higher." I was like, I can't see this going much higher like anytime soon. And lo and behold, they did. And if I think back to the prices they were paying then to what they're probably paying now, it would. If you'd have told me at that point they'd be worth that, I'd have been like, you are crazy. But that is just how the market is. It's how the economy works, how the market works. It's just it is. And we've seen the good thing about this is we've got years and years of data which backs this up. So we're not just saying this for the fun of it or just plucking random stuff out of thin air. This is years and years of data, hence us getting the 18-year property cycle, because that's using years of data to sort of map that out. So yeah, it's interesting when you look at it, but yeah, like you said, long-term gain.
Yeah, it's good as well, Toby, as you said, like you've got the statistics in place.
Yeah.
And we know with the UK and with the English market in general, it's had that track record and we've had the data to support that, which not all markets do.
Yeah.
So, I think it's always good to look into it. Obviously, you can't base it completely off of the past, but as you said, there are cycles that do seem to be a trend. So, yeah, it's interesting. I think it'll be interesting to see what happens.
Be interesting to hear this podcast back in a few years and be like, oh, how wrong was I?
You were right.
How right was I? I've got no issue with that at all, as I said, because it is a prediction and it's just something which, I'm personally interpreting myself.
I'm sure even if you look back in 10 years' time, you probably still be happy that you bought either way.
Yeah,
if there was a slight dip.
Exactly that. And as long as you're not over leveraging yourself and overexposing financially, then look, it's always going to be a solid bricks and mortar asset and investment. So on that side of things, you should be fine. But time will tell.
Yeah.
I'm not somebody that has a crystal ball that can tell the future, but we will see. It's interesting to see how it plays out. But like I said, I've just got that feeling when looking at the data, looking at the fundamentals, looking how the market is at the moment and what we've seen over the last year. It just really, when you slot it in to the 18-year property cycle, it really does. As I said, the main thing for me was thinking like we haven't had a mid-cycle dip. And I'm not saying the dip doesn't always have to be in the middle of the cycle. It can be at any stage, but we haven't had that dip. And as I said, I'll repeat it again, we haven't seen the market crash. It's not going to crash from how the market is at the moment. And even if you if people are factoring it to get slightly worse, for example, potentially, it's not going to really crash the market, the property market. So that's why I think at the end of this sort of stagnation / dip, we'll start to see because there's still a lot of affordable areas out there.
Yeah.
And there's still a lot.
Well, we're seeing it still, aren't we? We're still seeing growth in the areas.
Halifax, like we mentioned,
exactly,
over 3%.
They've still got that level of growth within the city.
Yep,
or the town,
because it's affordable. So yeah, I think that'd be a factor as well, because there are still affordable levels. So once it does get even more favourable and things settle, more confidence comes back in the market. Boom, people are going to come in, supply demand imbalance, and we could see a potentially aggressive. And again, I'm not saying that prices are going to absolutely like triple, quadruple. We don't know what the prices will do. We hope they do, and usually tend to find a more aggressive phase because that's how it works. But it might just be like a nice 10% rise, which again is big.
We'd all take, wouldn't we?
Exactly, we would now. So yeah, that's just my thoughts. Have you got anything to?
I'd say, to be fair, everything you've mentioned is fairly on par with what I would suggest and look into. I think the property market has always got something up its sleeve, right? So you never know exactly what's going to be happening with it. But as you said, Toby, I think a lot of the points you mentioned there give some good indication as to why potentially we could see another boom for sure, which I think, as you said, we don't always hear that in the media and the sources.
Yeah.
Some, obviously, bits of information that are put out there that obviously general investors or people who are looking into the market keeps them on the fence because they're not just quite sure. But I think, as we always say, I think it's good to take a real step back, look at all of the sources around you, get a real gist, and look at more so the data and facts rather than just opinionated or opinions just in general, because as you said, the guy saying there's going to be a 35% dip is massive, something massively that could affect it, which is just crazy. So
it's crazy.
Just I would say, whoever you're listening to or whatever you're reading, just kind of fact check it for sure.
Yeah. Speaking of forecasts and data and stuff, quite interestingly, yesterday Nationwide, the bank building society, they brought out their latest house price index, and they were showing a 0.3% increase month on month. Quite interesting. And they had, I think it was 0.1% increase the month before. So they're registering 2 months of increase. So that, again, you take that with a pinch of salt, and it's data based on sort of mainly their lending, etc., like that. So it doesn't take account the whole market. But interesting enough, it's just showing that, again, not as bad as some people are seeing out there. When you look at their data, but that's just a small couple of months. Obviously, we have to look over the year and over the next few years as well. But yeah, it was quite interesting to see that, which is good. And then when people listen to this, they would have hopefully been aware, because we had the news yesterday about the Bank of England holding the base rate as well. So that's good to see. They don't forecast it going up again. And like I said, there are murmurs that they do think at some point, maybe next year, probably the second half of the year at some point, they may look to cut it. But that all depends on the economy and how inflation's doing and what's going on at the time. But yes, interesting times ahead. So definitely don't be scared about property investing at this moment in time. I'm definitely not, and I know you're not as well. So don't be scared. Just get your facts right, get your data right, get your due diligence right, and as long as you've got a medium to long term mindset, you should be absolutely fine.
Yeah, absolutely.
All right. Well, thanks for joining us for another episode. Anything we've discussed today as well, if you agree with it, if you don't agree with it, or you want to ask some more questions, look, please feel free to get in touch.
absolutely.
We love discussing this sort of stuff, as you can tell, because we can waffle for a very long time on here. We have to time ourselves now, don't we, so we don't go over. Otherwise, we get electric shocks. You can't see on the video, but down here there's electric
You've got that
shocks.
ankle. You've taken off your ankle yet?
Yeah, no, not yet. I'm waiting for the episode to finish, because otherwise it just shocks us to make us
stop. To be
stop.
fair, you better wrap up now, mate. It's gonna
go off. Just here. But yeah, thanks for joining us, and we'll see you next time.
Take
Bye-bye.
care. Bye-bye.